Sir, I will request all of you to just switch off your volumes, please. Is my screen visible? Is my
Yes.
screen visible, please?
Yes, yes.
Okay, we'll start uh, the market talk today. Uh, All-time high is just a statistic, right? So there is a lot of rejoicing at every uptick in the market, and but the investors need to be more focused on their goals and not on the levels of the market. And we have seen that FIs have bought roughly around 72,000 odd crore since March this year, but it is much smaller than the outflow we have seen over the last year. Hence, one way to look at it is there is still a long way to go if the FIs keep buying and all the money keeps moving from China and advanced economies, etc. So let's see the market setup. US bond yields spiked up and the dollar strengthened and their equity markets sold out. So, though the Fed is still not really done with the rate hikes, I feel that the worst may be behind us, and this would do well, and all the markets will do well as the inflows will continue in the coming months. And if you see the Indian markets, FI index futures long have already reached 72% on Thursday. And the cumulative open interest has gone up, and all indices, Nifty, Bank Nifty, Fin Nifty, Mid Cap, everything are have gone up, and PCR has now has though it had gone to the overbought level has now come down a bit. So situation is not that bad as on date. In my view, we will discuss it subsequently also. Nifty may test 19200 or 18900 zone, and HDFC Bank is now nearing the entry point of around 1640, 1650. In my opinion, Eicher Motors is factoring in all the negative news below 3200, and the Bank of Baroda can continue its up move to say 230 or 250. Reliance can go up to 2750, so which will limit the Nifty's downside. And in my view, every dip is a buying opportunity from here for a target of roughly 20,000, hopefully in August. So, what happened with the Fed was their minutes of meeting, ADP employment report led to US bond yields going up. I think the 2 year yield went up to 5 and 10-year yield went up to around 4. So, the worry is that the Fed will have to tighten more to cool down the job markets. The next, I think the Fed meet is around July 25th, 26th, where a 25 basis point rate hike is in the bag. The AI revolution, which is in the initial stages, is powering the rally in US tech stocks. Nasdaq has returned 30% year to date, and Nvidia has become 4x in the same time. So, uh, whether it is a euphoria or is it just the beginning, nobody knows. So, 25 basis point hike at the FOMC's meeting next this month, that is July 25th or 26th, is in the bag because inflation is stubbornly high, and nothing will, I think, deter the Fed now because the labor markets are still hot, the GDP is still good from hiking at the next meeting. Now, the other point is that Asian central banks should now decouple from the Fed. What we used to see earlier was moment the Fed started raising rates, everybody else in the world will also start raising rates. Now the central banks in emerging world are much more closer to meeting their inflation targets and cutting the rates again. And the rates of the developed economies and the emerging economies are generally at the same similar levels now. Hence, that is the reason why there is a money flow which is taking place where there is growth. So the foreign investment in all emerging economies is on the rise. Because there is a big gap now between growth rates of emerging and developed economies, and the currencies of emerging economies are strengthening against the dollar as on now. Now, a very interesting point is about the gap between the bond yield and the earning yield. This is what I wanted to cover in detail. Indian markets are at 21x 1 year forward P. That is the forward FY24 P is around 21 times. So at current valuation, we can say that incremental returns may not be very attractive. And bond yield is what is the bond yield? Is the return an investor gets on bond investment. And earning yield is inverse of the P ratio. So as I was mentioning here, the gap between bond yield and earning yield is 2.3. So investors would be wise to pocket the gains post a sharp rally as the Nifty though marches towards 20,000, but the difference 20,000 plus is around 3-4% only from here. Now, why am I saying this? When equity yields are lower than bond yields, it indicates equities are expensive than bonds. Conversely, when forward earning yield of Nifty is higher than the 10-year treasury yield, the stocks look cheap. So right now there is a positive gap between bond yields and earning yield. Just to recapitulate, the 10-year yield today is around 7.15, and earning yield, if we divide 100 by 21, which is the present P, that is the inverse of P, is the earning yield. Earning yield comes to around 4.8. So the difference is roughly around 2.35. The gap at the peak, this difference goes to around 2.5 when the P goes to around 23, 24. So that is where the sell-off starts. So in the near term, I think the peak of Nifty in this move would be around 20,100 odd. That is another 4% from here. So need to be cautious. Now, talking about autos, the tractors and two-wheelers should do well going forward as the monsoon advances across the country. And as we were discussing just now, North India is seeing nice, good rains. So the demand for tractors and two-wheelers should be good from here. If you see the June quarter, the CVs reported that the commercial vehicles reported good growth. Premium bikes continue to be in demand, and now there is so much of competition with Hero and Bajaj also joining Eicher. Entry level bikes continue to be slow, which should improve now with better monsoon. The personal vehicle segment, Maruti did some few launches this last month. Electric vehicles continue to do well. Three wheeler demand is good with increasing economic activity. For a long and short term, the automobile scenario looks good. Now, I'll discuss one hospital today. This is called KIMS. It plans to replicate its success in Andhra and Telangana to the untapped adjacent geographies by capitalizing on its brand awareness. What it's doing is it is acquiring hospitals or even making greenfield hospitals and then improving their performance to improve their margins. The valuation of KIMS is at steep discount to Apollo, oblique Max, oblique Fortis, and others. The it is creating a 300 bed multi-speciality hospital at Nasik. At Bangalore, they are bringing up a 350 bed hospital. Thane, there is a 375 bed facility which is coming up, and it has newly acquired the Kingsway Hospital, which will, uh, with better performance, improve their margins. They have a Sunshine Hospital at Begumpet. It has excellent record of turning around acquired facilities. So people can look at this stock. Now talking about Titan, Titan reported a 20% year-on-year growth in its standalone business with double-digit growth across business verticals. So in this quarter, in their business update, they have indicated strong growth. The jewelry business of Titan is roughly 90% of their revenue. Healthy growth in watches and wearables eye care segment continues to benefit from network expansion. Market share is just 7% in the jewelry industry even now, and it is expanding because most of it, roughly around 70%, is unorganized sector. So Titan is like a shark in the ocean. There is a big market to capture. Carrot Lane had 32% growth, and at current market price, though expensive, it is at 62 times FY25 expected earnings. But it is the best stock in the consumer discretionary space is the respect to in India. And in India, you can't stop the demand for gold with so much of demand for jewelry and marriages, etc. This stock will always be a very good stock to hold. Now, the next point is about industrials. In India, there are two kind of themes. One is industrials, and other is infrastructure. In my view, industrials is a much better theme, niche theme, and has a potential to generate multi-bagger returns. We have seen so many industrial stocks uh, all across uh, whose performances have improved. And just for information, from May 22 onwards, the maximum FI buying has been in this space vis-a-vis the infrastructure space. Now, industrials are the input for all infrastructure and engineering and other industries. So, they have good order wins, credit growth, capex, and improvement in capacity utilization, which has spurred huge buying in industrial stock. It has seen influx of FI money routinely. Some of the stocks which are doing well in this space are Precision Wires, KEI, ACE, that is Action Construction, Jupiter Wagons, APL Apollo, Forging, Praj, LG Equipment, Astral, Ratnamani Metals, Apar Industries, Timken, etc. So there are so many, but it is a good sector to focus on. Now, here I'll just talk about the Nifty and the concept about Fibonacci retracement. Now, what I did here was in the last swing of Nifty, which took place from somewhere around 18640 to the top at 1950, 19521. Here, I just plotted from this base to this top the Fibonacci retracement levels. So, if you see, now Fibonacci retracement levels are at 23.6%, 38.2, 0.5, 61.8, and 78.6. Very beautifully, the Nifty has stopped at the 23.6% retracement level, and it may go up from there or go down from there. But whatever the Nifty does from here is the thing to be watched. Most probably, for relevance of the stocks are the 61.8%, 38.2%, and 23.6% retracement level. You can forecast up to what level the retracement can happen from here before the next move. So now, if you see, it can either go up from here, or if it goes down from here, then you can safely have a target of 19200 from here for a short term trading. So these levels provide good opportunity for traders to enter new positions in a trending directional movement in the market. So if you see, this whole move was roughly around 880 points. So as an investor or a trader, you can straight away multiply this 880 by the 23.6 or 38.2 or 62% and just see what are the likely levels to see support and resistances. But my point here is you have to see these levels in conjunction with the with the other charts and the supports and resistances level for the indexes. Now here I will just also show the HDFC Bank chart. Again, from here the up move started in HDFC Bank at 1630 and it went up to 1758. So I plotted this on this. Now it has come to around 78.6% retracement level. Now it can come up to this level in a short term or bounce back from there. So the bounce back is also reflective of the amount of retracement which takes place. So mostly what happens is it retraces after it has gone up and then there is an extension and the stock prices again go up. So the investors need to be careful about these levels and start looking at these levels for future investments. Now, talking about the defense theme for today, first I will talk about the defense shipbuilders. There are basically three shipbuilders: Cochin Shipyard, Garden Beach Shipbuilders, and Mazagon Dock Shipbuilders. If you see, first I have put their order books. So the order books are in front of you as on present time, roughly 85,000 crore, with each having a respectable order book as compared to their FY23 revenue. So roughly it's 5 to 9 times their order book, their revenue. So there is a revenue visibility over the next at least 3 to 5 years for all these shipbuilders. In terms of valuation, the valuations have come down now, and if you see the FY24 expected PE is around in the range of 16, and their current market prices are here. So, and they are paying good dividends also. So they are not very expensive considering the order visibility. So, what is the problem with these defense shipbuilders is that firstly we should not see them quarter and quarter. We should see them over the years, and because their execution gets impacted heavily due to various factors, and which impacts their revenue and margins. So everybody though is expecting good recovery led by higher execution in the current year. Margins are expected to improve significantly with more scale because operating leverage comes into play. Strong order book provides good revenue visibility. Stocks are, as I showed you, are attractively valued at around 16 times this FY24 earnings. Now, just for information, Cochin Shipyard recently bagged an order from Norway for six new generation diesel vessels. Mazagon Dock is engaged in construction and repair of warships and submarines. It won a contract worth rupees 2724 crore from Indian Navy recently. And ThyssenKrupp AG's marine arm and India's MDL are likely to jointly bid for an estimated 5 to billion project to build six submarines for India. So there is a good order pipeline and good revenue visibility. In addition, I would just like to say Cochin Shipyard suffered due to slow execution of large projects and delays in approvals recently. And also, a lot of time what happens is there are change in scope of projects. So one has to factor this and not look at them and buy and sell them every quarter if you have got them at a good price. So EBITDA margins are improving and they provide good dividend as I showed you. Next, I will talk about the other ones, BEL. Uh, Electronics account for around 40% of all the modern warfare leading platforms, where BEL is a dominant player in India. It has a strong order backlog and it has some traction in exports, which will drive near term sales, while large orders in the pipeline would also aid the medium term growth. The order book is roughly rupees 607 billion, that is roughly 60,000 crores. That is 3.5 times its this year's sales. And it is expected to do a 13% year on year growth in sales, driven by increased execution of significant orders and elevation of supply chain challenges. So let's see its projected earnings for this quarter. They are supposed to be improving by sales are supposed to improve by 13%. Even EBITDA is going to be better by 13%. Though the profit after tax is likely to be declining because some other expenses are there. They always have strong fourth quarter because a lot of government money comes in at the same time. So it's pointless to compare them quarter to quarter, because the fourth quarter or the last quarter of the year is always a big one, as you can see from here. Now let's see the P&L of BL. If you see, the sales have been improving all across every year. The operating profits, if you see, the percentage is improving, which is good. So it will lead to better profit. And net profit has improved, and EPS has also improved. Now it's roughly around 4. So if next year is around 5, so if you, even if you give it a 30 times earning, it should go to 150 in a short time, and it's good, decent dividend, around 30 to 40% it gives dividend. Next is BDL. BDL has an order pipeline of around 400 billion, that is 40,000 crore over the next 2 to 5 years, on the back of modernization efforts in the armed forces, with indigenization of the missile program. So expect a robust EBITDA margin of 19% in the first quarter for this financial year, which can be attributed to elevation of supply chain challenges. So if you see here again, it is likely to grow. Sales in this quarter are likely to be better by around 15%. EBITDA is going to be better, much better, roughly 263%, because there is a execution issues have improved here, and PAT is supposed to be also good. So just watch out for BDL. Though in terms of, if you see all of them, BL is trading at 2 standard deviations above its average P, while BDL is only 1 standard deviation above its average P. So all of them are impacted by order finalization. Now, if you, let's see the P&L. Again, the sales had gone up in this period of 2018 and 19, and after that it had gone down because of order inflow. It's expected to improve from here, and the margins are also had improved, but have, as the order flow goes up, the margins improve, and now it had gone down, but it's expected to recover. If you see, the EPS is roughly around 20. So it is right now expensive, but if you have a long visibility, you can keep holding this stock. Next is HAL, Hindustan Aeronautics. Uh, it got some 265 billion order inflow in FY23, but for the next financial year, this quarter or first half of FY24, the new orders are a little bit slow. So the sales will be driven by repair and overhaul of and the manufacturing revenue from platforms such as advanced light helicopters and light combat helicopters. Expect a EBITDA margin of 24% on an improvement from 22.8%. And recently, MOD on this Friday only signed a contract with HAL for procurement of 2 Dornier aircraft for Indian Coast Guard at an overall cost of 458 crores. There is an agreement which everyone is aware between US firm General Electric and HAL to manufacture the GE F414 jet engines in India. So if you see here again, uh, for this quarter is expected to have a sales growth of roughly 20% and EBITDA growth of 27%, and profits are likely to improve by around 15%. And EBITDA margins are supposed to be also better. Though it is expensive right now, its forward PE as is at more than twice 2 times standard deviation of its average PE, but with better visibility, the PE are expected to expand for these stocks. Now here again you see the sales are growing regularly, and operating margins are also going up. Now they're reaching around 25%. The net profits have improved, roughly doubled in the last roughly around 10 to 11 years, with more focus on indigenization of defense production, and EPS has improved to roughly 173 now, and they pay good dividend. So these are the sectors or the stocks to keep watch on, because they have clear earning visibility and they have no competition. So there is a moat which is available with them, and they have a competitive advantage because nobody else is likely to get into these sectors with the kind of technology and the wherewithal they have. Now let's discuss another interesting stock, which is called Jupiter Wagons Limited. It's a integrated railway engineering company which primarily manufactures freight wagons for the Indian Railways. Over time, the company has diversified into manufacturing of application-based load bodies on commercial vehicles, braking systems, and marine containers for domestic and international use. Its product portfolio includes wagons, wagon accessories, passenger coach accessories, and complete track solutions. It has launched new products like light commercial electric vehicles and freight braking system to expand into new markets. It will be beneficiary of much needed capital expenditure by railway in the wagon procurement. It's increasing its wagon manufacturing capacity to cater to increased demand from railways as well as private players. So it has an order book of roughly around 5,800 crores, and new orders are expected of roughly 25,000 crore, which are likely to open for bidding in the next few months. What it does is roughly manufactures 550 to 600 wagons a month, with a plan to increase the capacity to 700 wagons a month by end of this financial year. On an average, the company generates revenue of rupees 39 to 40 lakh per wagon, and it is coming up with new double-decker wagons for automobile sector, which can carry SUVs on both upper and lower decks, and with laying of new tracks, decongestion of existing tracks, and opening of eastern and western dedicated freight corridors, there would be further increase in demand of wagons. We can see their profit and loss accounts. So if you see, the revenues are going up, and in 2 years the revenue is expected to double. The margins have improved because of operating leverage. PAT has nearly become four times. Year on year growth is roughly 100 to 60%. EPS is now roughly reaching 12 rupees, which is expected for the FY25, and FY25 PE is around 14 times. EV EBITDA is decreasing, so that is good. It is becoming less expensive. Price to book is reasonable now, and it has got a healthy ROCE of roughly 28%. All these wagon manufacturers are a key for railways to regain the lost market share of freight traffic, which went to trucks. Now, railways need to order, at by some estimate, roughly 2.5 lakh wagons in the next 10 years. See, we have seen its valuation, roughly 14 to 15 times FY25 expected earning, and which is reasonable with a strong growth outlook. The ROE is very good. Risk is only lower spending of by railways due to high logistic costs. One more thing to be kept in mind is the Indian exports are not competitive, so the government is right now pushing the railway sector very hard and putting in a lot of capex on this. It will have a decent growth for the next 4 to 5 years. Let's see the chart of this. See, it is constantly trading above 50 DMA and 200 DMA. The 50 DMA is roughly around 140 as on date, and the stock is reached a level of all-time high of around 180. In my view, it's a good buy at dips because of the earning visibility for long term. Now, if you see, the revenue growth is expected to be good. It is just growing. Operating leverage has improved, and the EBITDA margins are now reaching around 15%. You see, EBITDA is likely to grow at around 54% CAGR. PAT is expected to grow at around 98%, roughly double 100% CAGR for the next 2 years. The ROEs and ROCs are roughly around 28%, which is very good. Hence, this stock is, for me, is looking very attractive. So investors can look at this stock. I have finished